Hello, good morning. My name is Chigozirim Wellington, and I'm here to present. I've done my past presentation for the financial analysis, and I'm working with McKinsey Corporation and Cardinal Health. Um, both companies are pharmaceutical firms, top competitors. They're both equally on the top 25 of the Fortune 500 list. Cardinal Health has been in business for about 100 years, and McKinsey Corporation has been in business for over 183 years. For McKinsey Corporation, they have over 60,000 employees within full-time employees, aside part-time and contract staffs. They have over 60,000 employees, both in the U.S. and all over the world, worldwide. And Cardinal Health has over 50,000 full-time employees, 50,000 employees working for them. So I'm going to go ahead and share my screen so that we can go into pattern sections explaining their profitability and how well both companies are doing in their industry so far. Okay, share screen. I am sharing. I have to share everything. 1, 2, oh, 2. Okay, now I can only share one thing. Okay. Yeah, let me just share the screen. I want to share this. Share screen. Okay, gonna minimize this and minimize this because I want you to be able to see my screen properly. Hope this is working effectively. So yes. So the CEO for McKinsey Corporation right now is Brian S. Tyler, and the CEO for the Cardinal Health Corporation right now is, I don't know how to pronounce his name properly, Brain something. No, not CEO is Michael Kaufman. For Cardinal Health is Michael Kaufman. So we're gonna go straight into the time series. I'm gonna be comparing McKinsey with the industry first, then I'll be comparing it with its competitors. So currently in the industry, the current ratio, which indicates the resources, if the firm has enough resources to meet the obligation during the next period. For 2019, McKinsey is about 1.2, even though the industry ratio should be about 1.99. Over the years, they've tried to maintain a balance of about 1.9 to 109 to 1.02, which is not too far from the industry average, but it shows that they could do better. Coming with that. Also for their quick ratio is really, really low, especially in the year 2019 and 2018. They did inherit some debt from a company organization that they bought. So basically the 2018 and 2019 corporate year was really, really poor on some of the ratios. So their quick ratio was really low, way lower than the industry average, and the quick ratio kind of shows how easily they can convert to cash compared to current liabilities. Okay, so when I look at the management ratios, asset management ratios, I think they did pretty well for the days of sales outstanding. They were able to convert their have sold out within 30 days, so that's about a month frame from production to selling out their products, which was which wasn't bad for the industry. The inventory turnover was also a lot higher than the industry average. And also with the total asset turnover, the total asset turnover was also higher than the industry average to show that the company is doing well. The account receivable turnover ratio was also on a good spirit because it shows that they were able to get money from their debtors as early as 11 times during the period. Under the debt management, so I'm going to talk about the debt ratio. I do have the graph for the debt ratio going further, so I'm going to explain that more. But they were able to utilize the debt ratio, which I believe the debt ratio was really good. They run the company more on debts than equity, which was very fine. They were kept it within 80%, 80 to 85%, which is good for a pharmaceutical organization looking for all the things they have to deal with the hospitals and all that. The times interest earned is the ability to meet the interest obligation, which shows that they weren't doing bad either. Though they were doing better in the prior years like 2015, 2016, 2017, but they're improving. They had a major hit in 2018, and that dropped their time interest earned figures. But I can see that in 2019, they're trying to ramp that up, and hopefully this 2020, they will do better. The EBIT ratio is also okay. And now moving to the profitability ratio, the return on investments was actually okay for the first few years till 2018. So they didn't have so much return on investment to give to the investors, but they're doing better than their other competitors, which are in the industry average. They're actually still making profit. So they're still making profit return on investments in their industry, which is actually very good. Their basic earning power is still about 1.48%. Their return on equity was really low, especially in 2018 and 2019, compared to their previous years where they did so well. Like 2017, they had about 45.70% return on equity, which was really good. But as I said, hopefully they will pick up as the year go by after the major loss. Okay, let's see. So if we're going to the market, the ratios, their price earning, books, the cash flow, they kept their cash flow stable at about 21.24. They've improved in their cash flow per share over the years. The dividend yield ratio, they kept it constant, is at 0.01. Their dividend payout about 1.15. They've also kept those two constant to show as they're growing over the years. So I'm gonna now compare both companies together within Cardinal Health and McKinsey Corporation. So Cardinal Health has picked up, although it's still a little small. It's a smaller company compared to McKinsey, because total revenue-wise, McKinsey, it's about $224 billion company, and Cardinal has over $100 billion. So they're actually still doing okay, and actually stepping up the game. And McKinsey has to really watch out because Cardinal is doing really good. Looking at their current ratios, Cardinal Health had a better current ratio compared to McKinsey. Although McKinsey has more assets to manage, but Cardinal Health is managing whatever assets and liabilities they have now. They're doing very good in industry. Their quick ratio, almost very close to each other. They're doing very fine. Slightly lower, some years slightly lower, some years slightly higher within both industries, but they had this very close together. This shows that they really utilizing their working capital for the firm, and they know what they're both doing in the industry. See, this is showing. Days of sales outstanding. For Cardinal Health, they kept their ratio at 20 days. So they're able to sell out from manufacturing to sell out. That's everything off their stock in about 20 days, which is 10 days lower than McKinsey. But if we look at the operation of what they produce, it's very competitive. Although they produce lower than what McKinsey make, because of course it's a bigger company, they're still able to be able to sell out what they've been able to make within 20 days, which is 10 days lower than what McKinsey is making selling out. The account receivable turnover ratio did a lot better than Cardinal, than McKinsey. Their total asset turnover also did better than McKinsey. Their fixed asset turnover ratio was lower, but it was not too far from from McKinsey's corporation. They kept theirs at about 60%, within the frame of 60%, from 60 to about 69%, while McKinsey had that all around 80 to 85, 87%. For their debt to equity, it was slightly lower than Cardinal. It was slightly lower than McKinsey, but when it comes to their time interest in, they did a great job in 2019. It was a lot higher, twice the amount for time interest in for McKinsey. So they did really good in that field. So here I'm showing the debt ratio, just for the explaining with a graph. Cardinal Health is in orange and McKinsey is in blue. Showing how McKinsey had a better debt ratio than Cardinal Health on the time. So to show that McKinsey is still a bigger corporation, although they had a major loss in 2018, they're still a bigger corporation than Cardinal Health. But Cardinal Health is really doing good in the industry. I'm going to still show my Excel files to show how I calculated some of these ratios and what I did. Basic earning power, Cardinal Health has a higher basic earning power. So when you have shares with them, you actually get more on your investment, which is what a lot of investors will look at in the corporation before you buy stocks in the company. How well am I going to get money back? So definitely Cardinal Health has been able to show that in 2019, they're able to give back more to their investors in the company. So that's what is also helping them. Hopefully McKinsey will be able to catch up again, but for now, Cardinal Health is doing a better job. The return on investment is also higher, especially in 2019. It's higher than higher than McKinsey. Their return on asset is doing better than McKinsey Corporation also. So these are all the things that anyone looking to buy shares will be looking at the company. And that's why McKinsey has to step up its game. If not, Cardinal Health is going to be a bigger company than they are. I'm showing on the returns on equity. Cardinal Health is in orange and McKinsey is in blue. You can see how, though McKinsey was at the top in 2017, you can see the major drop in that organization. And in fact, in 2019, just felt like they had nothing to offer. They had nothing to offer to their shareholders. And you can see that Cardinal Health, although also had, I think 2018 was actually a bad year in the industry for both companies, because most of the analysis for 2018 was really terrible in both companies. But McKinsey had a greater failure hit than Cardinal Health did. And I'm just going to assume that because it was a big company. But we can see Cardinal Health sparking back in 2019. McKinsey needs to find out what Cardinal Health is doing to get right back onto their feet. Also, McKinsey did move their headquarters, and that was also part of how they lost some money, having to get into a new building and refurbish and like moving a whole headquarters to Irving, Texas. They actually had to move their headquarters so they could save cost of how much they were spending on the organization, in the organization. So if we go down to look at their dividend yield ratio, as we can see again, Cardinal Health, although it's not up to 1%, right? But they're just slightly higher. They're slightly higher than McKinsey Corporation, which shows a company that is putting in the work. And so if McKinsey is trying to keep being at the top 5 in pharmaceutical industry, they need to make sure that they're able to make their numbers higher so that their investors do not drop. I know they have over 5,000 shareholders right now, but they need to keep putting in value in the market so that their investors will not leave, because Cardinal Health is picking up. So here, looking at the price earning ratio, McKinsey's price earning ratio grew bigger because of the company they acquired. It doesn't really mean that they have started making so much profit, but people decided to invest in them because they can see the opportunity for the company's expansion and how it's growing, and they feel this is something. So that moved up a lot in 2019, because of course they did inherit other people's shareholders, the shareholders of the other companies, so of course the price only moved up. So we're gonna go into the cost of capital analysis, cost of capital analysis, and we did do the after-tax cost of debt. So as of March 31st, 2019, McKinsey Corporation had over $705.95 million worth of debt, long-term debt, and leases. And in 2018, they had about $788 million worth of debt and leases in the company. So for us to calculate the after-tax cost of debt, we had to find out the cost of debt. Then from there, be able to calculate after-tax cost of debt. So what I did was I used my interest expense divided by my total debt. And for my total debt, I included long-term debts, leases, long-term debts and leases, current debts and leases, to be able to get my total debt. And that's how we're able to get the cost of debt. So they kept it a ratio about 3.48%, which is not bad for McKinsey Corporation. And from that, we used it with the tax rate. So I did go ahead and find the tax rate, which is about 63%, and use the tax rate by the divided by the cost of debt to be able to get the after-tax cost of debt. So after-tax cost of debt, they had about 1.29% debt that they're holding. Then we went ahead to the cost of preferred stock for McKinsey. They don't have any preferred stock. I looked, I couldn't find anywhere, so that's going to be 0. Not all companies have preferred stock. If your company has preferred stock, fine. If your company doesn't have preferred stock, that's also okay. Cost of internal equity using the CAPM approach. So I had to go ahead and get the risk-free rate from the Treasury site. The risk-free rate on the day that I checked was at 0.65000, so let's just say about 65%. And the market premium was 6%, and the company better from the slope is about 0.78%, because when I did the regression, I was able to get the company better, which was at 0.78%. 0.78, sorry, not percent, 0.78. So we're gonna, for me to get the cost of stock using the CAMP approach, we had to get the risk-free rate plus the market premium and better to be able to get it. And so we know that our risk-free rate is about 65%, market risk premium is about 6%, and better is about 7.08. And when I multiplied and divided it, just did the calculation, it was about 69.68%. That's gonna be the cost of entire capital from McKinsey is about 69.86%. So if we use the cost of internal equity using the dividend valuation approach, this went ahead to show, let me see if I can show my Excel file. Let me go back to my screen. New share. I'm gonna pick my Excel file. Just gonna share this desktop. Share it. Okay, yeah, I can see this. Okay, let me see. I did go ahead and try to move things around. These are all the calculations. No, it's not in here. Sorry, my computer is taking a toll. No, it's not on this one. Okay, I'm just gonna, not here, not here. Gonna move things around. Okay. Let's see, it's not here, there. Let's check this last one. Yeah, let's see. Okay, just a few minutes. So if we're looking, okay, so here's my regression and the calculations for the regression, everything in details within McKinsey and S&P 500, showing the regression equation. Do you get the regression equation here, and showing the points for the linear regression. Did go ahead and take the stock for 20, no, I think I jumped. No, hold on. I was trying to calculate the dividend. Okay, so here's the dividend valuation. So I did go ahead on Yahoo Finance and I downloaded the dividends for from 2015 to 2019. And we did go ahead and add it up, get the arithmetic average and the geometric average. The share price as of December 31st, 2019 was $136.79. I was able to get the return on equity for this by getting 2015, 2019 plus the share price. And we're able to get the return on equity and also even get a forecasted projected price for what the dividend payout for 2020 is going to be, which is about $1.78 for dividend payout for 2020. That's the projected from the calculation. Going ahead to show the valuation approach, I'm going to go back to my Microsoft Word here. So we did go ahead, as I said, dividend payout for 2019 was $1.60 per share. The estimated growth on Yahoo Finance was 3 3.44. That was the estimated growth for McKinsey for the 5-year period. It was said to be about 3.44%. And as of December 31st, as I said earlier, the share price was $1.36.79. And so I did DO for the estimated, for the current share price, PO for the current stock price, D1 for the estimated 2020 price, and G for the growth 3.4%. And we did calculate it, and cost of capital using dividend valuation method is shown to be about 3.4530%. So I also went ahead and used the cost of capital using the retained earning. Once again, picked up all the information. The firm's cost of internal equity as follows: D0, P0, D1 growth, and the flotation cost. So I tried to get the flotation cost. I couldn't find it on Yahoo Finance, so I did calculate the flotation cost to the best of my understanding, and I was able to get the expected. That was F46, which was, yes, of course, my projected times G46, which was the share price, plus H46, which is the growth. And that gave me the flotation cost of about $246. That was right. And putting that in calculation here, the cost of capital using the retained earnings is going to be about 3.4238%, which is not far from almost the same thing, all around, almost same thing, very similar to each other. Current cost of capital using the financial ratios, the weight of debt, the book value of debt. This was, I mentioned earlier, the weight of debt is in millions. We calculate the book value of debt. And if you want to be sure that your weight of debt and weight of equity is correct, once you're done with your percentage calculation, you see that it's going to end up 100%. If the answers you get for both of them don't end up 100%, then you know that you haven't done the calculation right. So you have to do it again. For the weight of equity and the weight of debt. And so we use that to be able to calculate the WACC, which is the weighted average cost of capital. Weighted average cost of capital is also one very important part of your financial analysis, because you have to be able to show the organization how well it's doing with the cost of capital, how well they're working with the cost of capital that they have, to know where they can cut their losses and where they can put their profit. And this after you've gotten your after-tax cost of debt, you've gotten the preferred stock if there's any, you have the cost of equity, you have to use all this to be able to calculate your weighted average cost of capital. And so here, so I did the weight of equity that I had, did the cost of equity I had, weight of debt, cost of debt, of course, and the tax rate for 2019. The tax rate for 2019 was, again, 63%. So did that and was able to get my WACC, which is around 4.48% for the year. So I have the formula there, E plus D times D plus cost of debt times bracket 1 minus tax rate. So the cost of equity is 4.8%, which is good since it's slightly, using the return equity is good, which is because it's slightly higher than the cost of debt. Then we move to the historical stock analysis. The historical stock analysis for the company, I did get the stock analysis from December 31st, 2017 to December 31st, 2019. So that's what we compared in here. And that's what we used to do, the regression that I showed earlier. So let me go back to that. Let's see. showing the stock history in the market. Didn't really go down, didn't really go. They've tried to make it constant. It's been constant, about 100 to 100 and something. Not really gone up, not really gone down, being constant. And they calculate the day, the stock price. We also did the regression here. And this is how I got the beta. Showing the R square, adjusted R square, the standard with the observations that I used. This is the ANOVA for the regression. Showing within the market, the standard deviation, the average daily returns, so they're doing okay. The better slope is higher, a lot higher than the industry. Better the R square, the y-intercept. The company is actually doing fine. In the industry, it's not having a bad time in the industry. And so we calculated the adjusted close and the McKinsey return and S&P 500 return. Okay, let's see. Let's keep going. Oh, so I do have the graph here. And also I did take a snapshot from Yahoo Finance on the stock, although of course the S&P 500 stock is the one in pink and McKinsey Corporation is the one in blue. Doesn't show that the stock was doing any badly, but it could do better compared to what the industry has it at. So if they keep growing, they can definitely meet up to where the industry are. But anytime the industry had a pick, they had a pick. When the industry had a drop, they had a drop also. So I did go ahead and attach all the documents here for your viewing and certification. Overall, I think both companies are doing well. McKinsey is a bigger brand financially, as we can see, is doing good in the industry. Could it do better? Yes. Cardinal Health is also a great company. It is doing good in the industry. Could it do better? In fact, it is doing better, and before we know it, it would also catch up to be where McKinsey Corporation is at the moment. Trying to see if there was any other thing that I missed out here. Everything that I did calculate, just in case I missed out anything, all the workings are in here, all the ways I got the answers are in here. So you can just look at it as I'm certified. But thank you for this assignment. And I was happy to present it. Thank you. So let's stop sharing. Yeah. And also stop recording.